The biggest driver of our really strong operating results has been the lack of new supply. And it's been driven by a number of things, but primarily just the cost of construction.
Joining me today is Jeff Edison, Chairman and CEO of Phillips Edison and Company. So Jeff, PECO recently updated its acquisitions guidance for 2024. Can you talk about the acquisitions environment you're operating in today and what you expect for 2025?
Sure. The acquisition market over the last 3 years has been bumpy. And I think primarily driven by interest rates and the ups and downs in the particularly the 10-year. And what we've seen is a build up of demand to sell, but a reluctance to sell in an environment with uncertain interest rates. And what we're beginning to see, we think, is the consensus that, rates are going to move up and down, but they're not going to get a lot lower. And so it's probably a reasonable time to sell for those who have a reason to sell. So we're anticipating we'll see more product on the market, particularly early next year and through next year. And so we think there's hopefully going to be some good opportunities on the buy side.
And how does the supply backdrop impact the leasing demand that PECO is seeing at this time?
Probably the biggest driver of our really strong operating results has been the lack of new supply. And it's been driven by a number of things, but primarily just the cost of construction. As we've had inflation in many parts of our business, we've had a lot of inflation on the construction side. So that's driven the cost of building up, which has really made it difficult to justify new development with the risk involved in on the new development side. So it's just put a real stop on new, on major new development. There's always anecdotally a few developments going on here and there, but as a whole, it's been a small growth in terms of new space. And what that's done is, in an environment where the consumer is still doing really well, the retailers are pushing to get into space and there's less space. And that's given us more pricing power and the ability to really work at the property level to get the merchandising that maximizes the value of each property. And that is it's the hardest part of our business, is to be able to realize that our profitability is driven by the profitability of our retailers, and our retailers and our shopping centers community and that we build is driven by having the best retailers, because the best retailers will drive the best sales, which then allow us to have better rents.
And what do you expect to be prioritizing at PECO in 2025?
I think it's very similar to what we've been doing over the last 3 years, which is to utilize the current environment to get really strong internal growth from our portfolio, and also to get external growth through acquisitions when those opportunities arise. So those will be our two big drivers for growth in 25, and we're very optimistic that it's going to be a really good 25. We think that we'll start to get some consensus on interest rates, whatever that may be, but that will encourage us to have more acquisition volume, as we talked about. But it will also, the operating environment on the leasing side should be able to drive us to, again, sort of record level spreads and on our new and renewal leases, and occupancy levels that are again records for us, and so that leads to a pretty good 2025.